we have discussed very briefly three models that can be used to assess or study the probability of defaults, and in the case of credit metrics, also the probability of migration, so the migration risk part of credit risk. There are obviously many other models. A very common one is logistic regression, which is a generalization of standard regression, in which essentially you end up with a model in which it's some sort of linear models that depends on a certain number of covariates, and once you have the model, by inputting the value of the covariates, you will have an estimate of the PD of the counterparty. But entering into that requires a little bit more technical details than what we cover here, or that I can assume, for example, from the generalized linear model point of view in terms of modeling. Now, an interesting topic, which I think it's rather useful also in everyday life, apart from this course, is to understand some credit risk derivatives that are out there and that are commonly traded on the market. One good example are CDS. CDS are the so-called credit default swaps. Now, they are swaps, so as all swaps, it means that there is an exchange of something. You know that the most common swaps are, for example, interest rate swaps. In this specific case, there is an exchange, which is a very interesting one. It is essentially an exchange of the risk of default of a counterparty. That's why we call it credit default swaps. A credit default swap is, apart from the technicalities of the modeling or the pricing of this type of objects that we will not consider, because it requires stochastic calculus, so obviously we cannot do that. It's to understand that a credit default swap is nothing more than an insurance that you buy. If you are the buyer of a CDS, you are buying an insurance, like your car insurance, like an insurance of your house for damages, like a travel insurance. So you are trying to insure yourself against something. That something in a CDS is the default of someone. Now, that someone is what, in the terminology of CDS, is called the reference entity. So the reference entity in a CDS is typically the issuer of a bond or of a series of bonds that you have in your portfolio. And since we know that bonds can generate losses in our portfolio because of interest rate risk, because of all the other things that affect the value of the portfolio, but also because of the default of the counterparty, we may try to find ways of covering that risk of default. In the terminology, again, the counterparty that issues the bonds against which we want to have an insurance, it's called the reference entity. And in the terminology of CDS, but it is essentially spread in credit risk management in general, the default of a counterparty is defined with a fancy euphemism, which is credit event. If there is a credit event, it means that there is the default of someone. Now, the reference entity, it's there, but it's not part of the CDS itself. The CDS itself is a contract between two counterparties, the buyer of the CDS and the seller of the CDS. These are the two active parts in the transaction. The buyer of the CDS is obviously, apart from trivially the guy that buys the CDS, is the guy that takes the insurance, that is buying the insurance. It typically works like that. There is a company, whatever company there, name one, General Electric, issuing bonds. I buy the bonds, and they are in my portfolio. Now what I want to do is to try to cover for credit risk. So I want to at least cover the risk of default of General Electric. That is to say, to lose money on my bonds. So I will look on the market for someone to enter in a CDS with me. But that someone is not General Electric. Okay, General Electric is the reference entity in the sense that the bonds that are part of the CDS are issued by General Electric. But I am the buyer and I'm looking for a seller of the CDS. So what I want to buy by paying the premium of the CDS is insurance against the default of the reference entity. There are different types of insurances that I can buy, because obviously I can insurance, if you want, the entire face value of the bonds, just a part of the face value. There are other minor changes, but in principle I want to be safe in the case of default of the reference entity. The seller of the CDS is the guy that is selling me the insurance. So it's the guy that takes the risk of default of the reference entity. In exchange for this, in exchange for taking the risk, it will receive a premium paid by me over time. And it's really like an insurance. If you have a car and you have a car insurance, how does it work? You regularly pay the car insurance. If nothing happens, so if you don't have accidents, you are paying for the insurance, but the guy that only receives the money is the insurance company. If you have an accident, the insurance company will take the risk and will pay you back the damages and all the things that are included in your insurance contract. This is exactly the same stuff. So if there is no credit event, so if the reference entity does not default, there is only a payment from the buyer to the seller, and that until the expiration of the contract. If there is a credit event, obviously the buyer stops paying the seller, and it's the turn of the seller to pay back the buyer to cover for the default of the reference entity. It works like that. So we have a CDS buyer, a CDS seller. There are two streams of payments. There is a regular stream of payment that we call the premium leg that goes from the buyer to the seller. Typically, the premium that the buyer pays to the seller is in terms of basis points that he or she pays per year over the bonds. In case of a credit event, there is a second leg that opens that is called the protection leg. The protection leg is essentially the payment of the seller to the buyer, and it works like that. What happens when there is a default? The reference entity defaults. If I have the bonds, those bonds are worthless, or at least we know that in reality there is a good chance that the secondary market will open and that we can try to recover part of that, so we can compute the market LGD and blah, blah, blah. But in any case, I will have a loss, because nobody will pay me the full value of the bonds. But if you are entering a CDS, I do the following. If General Electric defaults and you are the seller of the CDS, now it's your stuff. So you take it and you pay back to me the full notional value. So for me, there is no loss. Now it's his problem to recover and to do whatever he wants, or to set them on fire. He can do whatever he wants once he has the bonds. But I get all the money. So for me, there is no loss. Now, in reality, most of the time you don't see completely the notional principle. You see some other type of agreement that takes place between the buyer and the seller. But if we want to simplify, we can say that it's just the notional principle. So if the value of the bond issue was 100 and the reference entity defaults, I take the stuff, I give it to the seller, and the seller gives 100 to me. So I'm safe. Now, imagine that last June, so June 20, 2019, two parties agree to enter into a 5-year CDS. So this CDS is over 5 years because very likely the bond issue, which is underneath, is over 5 years. With respect to a specific reference entity, that again, I stress, it's very important, it's not part of the contract. It's there because it issues the bond, but it's not part of the CDS contract. Imagine that the notional principal of all these bonds and stuff like that is 100 million. So in my portfolio, if I'm the buyer, I have 100 million of that stuff. What I agree to pay as a premium, as the premium I would pay for the car insurance, for the travel insurance on a yearly basis, is to pay 90 basis points per year on the notional principal. Then typically this payment is not once per year. The amount is computed once per year, but then it's split in intermediate payments like every month, every 3 months, every 4 months, so you choose. Here we have quarterly arrears, so every quarter there is a payment of this amount for protection against the default of the reference entity. So what does it mean? If there is no default, if between June 2019 and 5 years, so we are going to 2024, there is no default, every 3 months the buyer of the CDS will pay to the seller, in the specific case, about 225,000 euros. And how you get that? You have to compute 90 basis points of the fee of the notional principal. The notional principal was 100 million. 90 basis point is 900,000, and then you split in 4 payments because these are quarterly payments. So every quarter you pay 225,000 euros to the seller, and that's every 3 months. Okay? So typically, when you enter in a contract, so the guy in the example entered in June 20, last June, so 2019, you don't pay when you enter in the contract, but you pay after a first deadline. So these are quarterly payments, so the first payment is in September. And the payment in September is meant to go back. So it's paying the 3 months that have passed. Okay? So that the next payment that will be in December will cover the period September, December, and so on, in this way. Okay? There is a back payment. This is how it goes from what concerns the premium leg if there is no credit event. So if there is no default of the reference entity. So assume now that we observe a default in November 2021. Okay? What happens? Since there is a default of the reference entity, the premium leg stops. So there will be no longer any payment from the buyer to the seller. But the seller will have to pay back the notional principal, in this simple example, 100 million, to the buyer. Now, a phenomenon that happens is the following. As I told you, this buyer pays every 3 months in our example. And the chance that a specific default happens on the day 20 of June, September, December is not very high. Default will happen at any time between payments. So from one payment to the other, it can happen at any time. So since when the buyer pays in September, he is covering back June, July, and August. And when he's paying in December, he's covering back September, October, November. What happens? At a certain point, and that's why I told you that typically there is never the full notional principal paid back, there is an accrual factor. So since there was a default in November, and that part of the contract was not yet covered by the buyer, because the buyer last paid in September, and September was for the summer, the buyer will have to pay the 2 months up to November. So when there is the transaction between the seller and the seller will pay back 1 million minus what? Minus the part of the premium that the buyer should have paid until November. In that specific case, what you do, you take 900,000, which is the yearly premium, you split by 12, and you multiply by 2, because these are just the month that were not covered by the previous payment. Okay? So in the specific case, the payment leg or the protection leg from the seller to the buyer is 1 million minus 150,000. Okay? In reality, again, there are most of the time other settlement, but we ignore that. Now, the CDS spread, what we call the CDS spread, is nothing more, and it's extremely important, you will see why in a minute, it is nothing more than the total amount that is paid every year by the buyer to the seller as a percentage of the nominal principal. In our example, it was 90 basis points. So the CDS spread of the example that we are considering is 90 basis points. As I told you when we were playing with interest rates and duration, basis points are a typical unit of measure that we use with interest rates because interest rates tend to have small variations. So instead of considering a percentage of 0.00001, we introduce basis points. So 90 basis points is 0.9% if you want. 200 basis points, you can immediately change 200 basis points to 2%, and these kind of things. So the CDS spread is this quantity, is nothing more than the premium that the buyer pays to the seller on a yearly basis, typically, as expressed as a percentage of the notional principal, but is also a measure of the riskiness of the reference entity as perceived by the market. And in fact, CDS spreads are available on the market. If you want to have an idea of the risk that the market assigns to a given company, or the risk that a market assigns to a given country, you can open your financial newspaper, you can go on financial websites, and you will find information about CDS spreads. So, typically, in the Eurozone, we have all the spreads that are computed with respect, say, to Germany. So, a spread is nothing more than a difference among two things. Can be a difference on prices, a difference on quantity, but when we are speaking here, it's a difference on interest rates. And the CDS spread would be the price of the risk that the market assigns to a specific bond issuer. If it's a government, so you are considering govies, it will be the risk assigned to a government. If, for example, last year or a couple of years ago, where there was a lot of political problems, not that now they are solved, but for sure there were a lot of political problems in Italy, and you were looking at the CDS spread on the Italian govies, you could actually see that the spreads were going up. They were going up as a measure of the perceived riskiness of the country, of the default of the reference entity, of the default of Italy. And the same for all the other countries. If you consider Greece, when there was the big crisis, and all the bad things that happened to Greece, there was really madness for what concerns the CDS spread of Greece. If you consider other countries like the Netherlands, typically the CDS spread of the Netherlands, it's not zero, because actually no country has a theoretical zero probability of default, but it's actually zero. So it's very, very close to zero. It means that the market perceives the Netherlands as a safe country. The same for Switzerland. The same, relatively speaking, for France is a little bit more, but still, the US, and so on. So the spread is very important, and it's a measure that you can read on newspaper. And why it is important that you know that? Because now I will show you some very simple formulas that you can use if you want to make some financial decisions. Now, the spread is a way, and as I was telling you when we considered credit risk initially, the spread is always sentiment based. So it's a measure of the sentiment of the market with respect to something. So if there is euphoria or depression on the market, these are typically the most volatile things that you can observe. But now they are nevertheless measures of the perceived riskiness of the reference entity. And good for us, this quantity, the CDS spread, can be used to quickly estimate the PD of a counterparty. Really very quickly. Now, the derivation of the formula that we will see in a minute is much more complicated than the formula itself. And it is based, as always, on a certain number of assumptions. So the first thing that you should know about the formula that we're going to see, even before seeing the formula, is that that formula makes sense when there is no extreme change of sentiment on the market, so typically not during a crisis. If you try to use this formula during a crisis, you can get very absurd results. Typically, this formula is reliable when there is no particular problem on the market, so when the market is in good and standard conditions, as usual, with all this type of things. You know that we are risk managers, we have tools, they typically work, then they start not working depending on the situation of the market. And the last thing, the only measure that you can use is to pray if you are a believer. Otherwise, it's just fate and you wait for that. The estimate that you get also in good market conditions is not the best estimate ever, so it's not the most precise. You can have better estimations using other approaches, but it's definitely very quick. You will see it's just computing a ratio, so nothing particularly complicated. So imagine that the 5-year CDS spread for a given company, again, the reference entity, is 240 basis points per year. Okay, so that means 2.4% per year. Assume that we know that the recovery rate for that type of company, and recall that I told you that for the different type of companies you can find this information. So rating agency typically provide this information. Obviously, they provide averages. So they will tell you what is the average recovery rate of a company in a specific sector with a specific size. They will not tell you exactly that company. So also there you understand why the formula is an approximation. But if you know that the recovery rate is 40%, so the loss given default is 60%, which is 1 minus 0.4, what do you have? You have that the average yearly probability of default, sometimes they call it default rate, but from a statistical point of view is not correct. So I think that average yearly probability of default, it's more reliable as a definition. Over the 5 years, it's simply given by taking the ratio of the CDS spread, 0.024 as decimals, divided by the loss given default. So 1 minus the recovery rate, which is 0.60. You compute that, and it means that the market for that specific counterparty, for that CDS spread, is estimating an average PD of 4% on a yearly basis. Now, you can imagine that for very large corporations, for governments, it's not that you have to look for a buyer. So you really have to knock at the door of different people to look for a buyer and a seller of a CDS. These are quite standard. So for every issue of Dutch govies, for every issue of German govies, for every issue of bonds of, I don't know, Google, immediately together with the issue, there will be a set of CDS spread available, because the different agents on the market will say, okay, if you want to buy an insurance against the default of Google, this is the price I'm willing to offer. And this price will tend to coordinate quickly. So it's quite common to find this information on the market. If, on the contrary, you want to buy a CDS on a new, very obscure company that popped up yesterday, in that case, you will not find a CDS on the market. You will have to find a seller. So you will have to find someone that is willing to enter in a contract with you. So it's not just a standard contract that you can find on the market. But the behavior is exactly the same. So the formula is nothing more than the credit spread over the LGD, or 1 minus the recovery rate, as you prefer. The same type of formula can be used in a more general setting, which is the following. Very often, you have that a counterparty, the reference entity, issues bonds for different maturities. Like, for example, 1 year, 2 years, 3 years, 5 years, 10 years. But it would be difficult, for example, to find a bond of 12 years or 8 years, these kind of things. And still, you might be interested in computing, for example, the PD of your counterparty in a specific period for which an exact CDS is not available. So what you can do, you can try to combine information from different CDS in this way. Imagine that for the same reference entity, it needs to be the same, obviously, you have a 3-year CDS and a 5-year CDS. The spread in the first case is 50 basis points. In the second case is 60 basis points. This is typically what you observe. It's not a general rule. Sometimes, and in the last years, we see a lot of madness about these kind of things. But you can imagine that, in general, the longer the time horizon, the higher the spread. Why? Because in principle, if you have a longer time horizon, risk should increase because uncertainty increases. Over 20 years, very absurd things can happen. Over 2 months, the chance is much smaller. But, for example, on govies, we have observed situations in which the spread on a short-term horizon was higher than the spread over a long-term horizon. Just because for countries, more than for companies, you have politicians. So it could be that the market does not trust a specific politician, but he also knows that maybe in 20 years the politician is no longer there. Okay? So for govies, it's not exactly true that you see this increase. In principle, yes. For most countries, when you have countries with funny politicians like Italy, you can have whatever you want. Okay, so imagine that you have these two spreads, and the recovery rate for this counterparty, for this reference entity, is 60%. So the loss given default is 40%. Now, what we can compute is immediately the average PD over 3 years using the first CDS, and this is what we compute to be 0.01 or 1.25%, and the average PD over 5 years using the second is 1.5%. Okay, these are the two PDs. Now, what I can ask myself is, if I have the PD over the first 3 years and the PD over the first 5 years, and I want to know what is likely to be the PD between year 3 and 5, assume that I want to make an investment with this counterparty between year 3 and 5 today. And I have to get an estimate of what can happen according to the sentiment of the market between year 3 and 5. So what I can do, I can essentially use this very simple formula. So I take the time horizon of the longer CDS, 5, times the corresponding PD as estimated using the CDS formula, minus the time horizon of the shorter CDS, 3, times the corresponding average PD as estimated with the CDS formula. And I divide by the difference in the two time horizons, 5 minus 3, 2. I compute that, and what I get, the average PD between year 3 and 5, it's 1.8, as perceived by the market at the moment. The formula is this one. Y is the time horizon of the longer CDS times the corresponding PD minus the shortest CDS times the corresponding PD divided by the difference in the two time horizons. Now, this formula, it's very similar to something that I guess you have considered in other courses. Do you see any resemblance between this formula or something else that you have considered in the minor? Ignore that this is PD. But this formula should be similar to something that you should have seen in other courses in the minor. No? Have you seen forward rates? Okay, this is the same formula that you have for forward rates. Forward rates are the rates that you can infer from the yield structure on the market for the future. It's like I have a given zero rate between time 0 and 3 years from now. I have a given zero rate between now and 5 years. And I want to know what, according to the market, would be the likely zero rate between 3 and 5. So a 2-year zero rate, but not now, in 3 years from now. So again, I'm making this sort of idea that today is day 0. I make 2 steps, 2 years from now, and okay, I make my projection. 3 years from now, sorry, in my example, and then I make this projection. These are called forward rates, and the formula is exactly the same. So they work exactly in the same way. And forward rates are quite used to try to understand expectations you can imagine for what concerns interest rates. Okay, so this is the last topic that we consider together for what concerns the probability of default. The other quantities, like the exposure at default and maturity, for what concerns maturity, there is not much to say. There is a bunch of formulas provided by the regulator, so nothing particular exciting. For what concerns the exposure at default, this is something that for many years was considered as given and deterministic. It is no longer the case. There is a new sort of modeling coming out, but it's rather fresh and advanced as topic at the same time. So for what concerns credit risk, we just stop with these models for the PD and the LGD.